We still have one more small session. It's just small, but it's actually would be very interesting. We're going to close with a short fireside chat with the CFPC commissioner. And the moderator is Professor Richard Herring, again from the Wharton School. And again, he is one of the organizing committee for this event.
This is, in a way, the completion of our tour of the viewpoints of the 6 federal regulators who have a toll on this. And you might well wonder why we waited until the very end for this. And I think the answer is scheduling issues. But in a way, the CFTC is everybody's favorite regulator for the digital space. You can see a lot of enthusiasm in Congress, and almost everybody I've talked to in the fintech world, especially in the crypto world, would love to have the CFTC as their regulator. And we're very lucky today to have one of the new cohort of commissioners who have joined the CFTC in March, I believe. And we're particularly lucky that the commissioner we have with us this afternoon is Christy Goldsmith Romero, who has a remarkable background and an unusual background for the CFTC. She has spent considerable time at the SEC as advisor to 2 chairs, actually during the crisis, so it was a baptism of fire. She spent, I think, almost a decade with the TARP investigations, and so she knows all sorts of corruption up close and in a prosecutorial way. And she was part of a group of inspectors general that oversaw FSOC. So, broad range of experience, and it's a very interesting perspective to have on the CFTC, which usually has a very narrow focus. But let me then pose the question to you, given that the CFTC is famous for focusing on markets, commodity markets are things that can be construed as commodities, and institutions are the main players in those markets. How do you think about modifying or adjusting regulations and supervisions to fit what is becoming increasingly a retail market in some sense?
Thank you. I really appreciate being here. I want to thank President Harker. Thanks to the sponsors and everyone for having me. Let me give my standard government disclaimer, which I'm sure you all are used to, which is the views that I would say are my own and do not necessarily reflect the views of my fellow commissioners or the commission or our staff. So let me level set about the CFTC for just a second in this space. We're not new to the space. For 5 years, we have been regulating digital assets, including cryptocurrencies, in the derivative space. So about 5 years ago, in 2017, we started regulating Bitcoin futures being traded. And then I think since then, it's been crypto derivatives trading on 11 regulated exchanges. I think currently there's somewhere around 20 cryptocurrency products that are trading on our derivatives markets. So this is something that we have experience in and that we have been regulating. At the same time, we also have the enforcement arm. And so we've brought over 50 enforcement actions, which includes some big actions like the first to bring an action on stablecoin, which was brought against Tether related to misrepresentations surrounding how stable that stablecoin is. We've also brought failure to follow AML, failure to register with us when you are conducting activity that should be a registered entity. So we've been in this space for a while, and I think that is why there's been sort of this gravitational pull towards saying, well, perhaps the CFTC can do more in this space because they have been doing it successfully. By being able to do both the derivatives space and the enforcement space, we can see this rise of retail, which is what you're talking about. And so think about retail in this space. In the derivatives space, we don't usually see very many people. You're not really seeing a lot of retail customers in the derivative space. And so as I'm looking at the type of customers that are already we're seeing in the crypto derivative space, but that could come as a number of these companies are coming in and saying, we want to be regulated by you in the derivative space. Let's put aside for a second whether there's any expanded authority under legislation. A lot of these companies have very big brand name recognition. They have a lot of retail customers. So then, from my mind, I have to start to think, like, do we have the right customer protections and guardrails in place? So because retail is not really historically been in the derivative space, retail's not defined for our space. In fact, what has historically been thought of retail ranges from like my adult children all the way to a hedge fund trading $4.9 million. So that's a pretty broad range. There's
an important distinction to be made there.
There is. And so I'm thinking about sort of risk tolerance, and we have to sort of think about this and think, what should we be doing if there's a different customer base for our markets? Let's just stick on the derivative side again. And so I am someone who firmly believes that if regulation does not keep pace with technology, it's going to be the most vulnerable people who are hurt. And so as we are thinking about this great promise of financial inclusion, expanded access to financial services, it's very important that I think about President Biden's executive order, which says expanded access to safe and affordable financial services. So you say, well, what does that mean, safe and affordable? And what does it mean for our markets in the derivative space? And so that's got me sort of thinking about important questions related to margin and leveraging and disclosures and those types of aspects. And it was really interesting in the last panel what was said with that's not really on the consumer. I mean, it really should be on the regulated entity. And so as we look at this rise of retail, I do think we have to look at our protections and say, you know, are they appropriate? Do we need more?
Do we have any way of measuring the size of the retail population? I realize, having said it's hard to even define, that may be a little premature, but one has the impression with Super Bowl ads, and frankly, from what my own students are doing, there are a lot of inexperienced people playing in the market.
So I think if you look at the statistics related to cryptocurrency, there are a lot of young people, big percentage born after 1980. There's also a large percentage that earn under $50,000. Now, and minorities as well. And so the thing is like some might have the level of sophistication to understand risk, but that's what I'm looking for as a regulator, right? We want people to understand risk. We want informed investors, informed customers. And so where do we put that? Do we put it on the consumer and deny access, which could then hurt the goal of financial inclusion? Or, do we put it on the regulated entities? And I think, that's where I'm leaning.
The question too is, how do the retail investors finance their participation in the market? And yeah. I only have some casual anecdotes. I think you have even more that makes you worry about leverage upon leverage.
Yeah, I mean, this is one of the things as you're starting to look at statistics, it can become very hard to find the statistics that you look at that sort of captures the whole market. You're seeing some statistics where 35% of cryptocurrency buyers are buying it using a credit card. And then I just recently saw a survey about a percentage of the people who responded to the survey using payday loans or title loans to purchase cryptocurrency. And so you think about what kind of return you would need to get to even break even. But this really goes to this idea of what is safe and affordable financial inclusion, expanded access, and what can we do as we think about putting in those guardrails or certain requirements, for our exchanges, for our clearinghouses, related to margin, for example, or leverage and
or suitability, perhaps.
Yeah, or suitability, and it's not really set up that way right now. I mean, other than sort of if you go with sort of the classic market structure where you have all of these intermediaries that play some part of that. When you get into playing with that market structure, then you have to sort of look at who is making that up. And so when I look at this, I ultimately, as we are determining what is the framework that we are going to create for the regulatory environment, at least for the CFTC, I certainly follow the principle of same risk, same regulatory outcome, right? So we're seeing, and we've seen in the last few months, risks that look very similar to sort of the traditional financial system, some of the same risks, contagion, risk of runs, conflicts of interest. And conflicts of interest we're seeing more and more. Conflicts of interest is really interesting and something that I've been thinking a lot about lately. You have this situation where you have entities that want to perform multiple services. And in some instances that they are, or with their affiliates, want to be sort of every part of the trade. And so you have to think about the conflicts of interest there. Like if you're the exchange, but you're also market maker, and you may be trading against your customers, and you also have custody, you're also the clearinghouse, you're also the broker or your affiliate. How do we minimize the conflicts of interest that can come with that? And then just from a contagion standpoint, you are increasing the risk of contagion. So these are all sort of things I'm looking at in terms of conflicts of interest. And then let me add one other, which is this segregation of customer assets. And I think in the United States, we are all sort of used to, if we have a bank account, if we have an investment account, we decide what to do with that, what's in there. We decide how to use it. We decide when we can pull it out. And what we've seen, particularly in the last few months, is that a number of these companies will have actual rules that say that they, in some instances, can use some of the customer funds to meet operational demands, or there's freeze ups on redemptions, or we've seen several of the cyber hacks with thefts. And so this idea of like, does the customer actually have sort of control and possession of it, or does somebody else? And that's something to be looked at in terms of customer protection.
I think that's right. And in a way, the classic argument about why securities regulation is sometimes more resilient than bank regulation is that if you have a bank deposit, it's an undifferentiated claim on the bank. The FDIC backing it up, one hopes, but nonetheless, you're mingling your funds with the bank's funds. But with securities and a segregation of customer funds from the firm's own funds, in principle, you can resolve them very quickly, and the customer is protected by this segregation that needs to be strictly applied. And I think a lot of people dealing in these markets assume that is the case because generally it is true in the U.S.
Yeah, and it may be for some companies, but I know that it's not for other companies. And when you dig into what would happen if the company files bankruptcy, what would happen if there's a run and they freeze it up, and what are you entitled to? And I think there's a number of people over the last few months who faced a lot of trouble and may still face trouble in getting their funds out and being able to do. So those are the types of things that I think we've got to think about addressing as this asset class is looking to expand into the regulated space. I mean, so much of it is this question of, will regulators change and make bespoke regulation for digital assets? And so if there are parts that really will not work within regulation, I think it's fair to say, or doesn't work now, maybe, I think it's fair to say that we can look at it. But then the question back to the industry is, well, if you want to come within the regulated space, you also might have to change. If you have a design, your business model is based on being outside of the regulated financial system, and now you want to come within. It doesn't mean that we have to take you as is. We have built up a series of guardrails and protections, and the fact of the matter is, given what we've seen and the vulnerabilities that have been exposed over the last few months, having strong guardrails, having strong regulation could actually increase the resiliency of this asset class in the regulated space and actually bring confidence.
If I might shift focus just a bit at the end to something broader. Over the last 2 days, there's been a lot of discussion about how you strike a balance between innovation, which in principle everybody applauds as promising a much brighter future, and safety and consumer protection and protecting against fraud and so forth. And as I understand it, you are going to chair a committee on a technology advisory committee.
Right.
And so I'm curious about how you're framing the question and how you propose to think about the trade-off, because it's very difficult.
Yeah, so at the CFTC, each one of the commissioners sponsors an advisory committee. And so I'm sponsoring the technical advisory committee known as the TAC. The idea is that we bring in a broad coalition of stakeholders, and it's got to be a diverse coalition of stakeholders so that we get different views. And then we have a number of subcommittees. One will be sort of cryptocurrency or virtual currency. One will be blockchain. I mean, there's other things related to, electronic trading and other technological advances and fintech issues. So I think the idea is to get that membership. I'm about to do an announcement for new members because the membership hasn't been updated in a while. People from the public will say what they want, from the industry or from public interest groups or academia or wherever, and say they want to be part of it. We choose a broad coalition, and then we sort of talk about these issues. And if we can talk about them and coalesce around sort of, some advice, which is the whole point of this, some advice for the commission and how to move forward. It's a really great sort of public forum because a lot of this is very public, and to say, here's what you should be thinking about as you move forward. And some of it is not just cryptocurrency or market structure. Some of it has to do with how, blockchain and the use of blockchain, or this idea of we have a lot of data, trade data, and what do you do with that? I mean, so a lot of it is really just trying to get advice from a broad base of stakeholders.
Do you have a sense yet of what the agenda will be?
No, I think I'm gonna call the membership first, and then I'm gonna talk to the members and say, what are the things that, how do you think of this? I do think we need to be talking about what guardrails should be there, how to strike the balance of ensuring that any innovation that is promoted is responsible. The idea of financial inclusion, I think, needs to be talked about. And I think the ideas of market structure, intermediaries, non-intermediaries, who's performing what function. But I do think we have to be thinking about, if I say same risk, same regulatory outcome, that doesn't necessarily mean same regulation. But the idea is we have a regulatory framework that has really worked well for the derivatives markets for a long time and did well during the pandemic, is doing well now, and has done well for many, many years. So the idea is, how do you achieve those same principles, those same outcomes, by thinking about it with a different asset class? And so, if you think about changing market structure, you have to think about, well, the current market structure provides the following benefits and advantages. How are we still going to achieve those advantages if we should shift in any way the market structure?
And you have a particular challenge with this market in that it's global. And often it's selecting jurisdictions that, shall we say, are not famous for the quality and rigor of their financial regulation. I know IOSCO provides some overlaying principles, but to what extent have you been, well, will you be, I realize this is unfair, given that you've only been on the job since March, but to what extent do you think you can cooperate with similar regulatory authorities in other countries?
Already doing it. Already doing it. I was just out in London meeting with all the financial regulators out there. I've been meeting with the European regulators as well, and that's going to continue. I've got an Asian trip coming up and going to be meeting with them as well. I think we're already doing it because the idea is, if everyone is looking at the same regulatory framework, now's the time. I will say this, for a while, the thinking was, the U.S. is not going to do that much. Overall in terms of federal regulation. But then the CFTC actually started 5 years ago and started regulating and thinking, well, let's be a leader and let's see if we can't, try it, see how it works, see what we need to change. There is a reason why a lot of the industry wants to be regulated in the United States. And that's what they want. So they have, if we could talk about in generalities, they tried going to other countries. Many of them are in other countries, and now they're seeking to come into the United States. Why? We have the strongest and safest and most trusted financial system in the world. The question is, how do we keep that while still bringing benefits of things like blockchain with transparency and accountability and all of that, and being able to ensure that there is expanded access to safe and affordable financial services?
Inevitably, we've asked more questions than we've answered. And I'm very sorry that our time has grown short. But please do join me in thanking Christy Goldsmith Romero for an interesting overview. And as a member of the organizing committee, I would like to thank Jalapa for the 6th year having carried out this remarkable job as impresario of the conferences. Thank you all. Safe travels, everyone.